afternoon. Welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. In a major move to cut costs, banks across the country are starting to charge users for cash transactions above certain limits and for facilities which were free till now. State Bank of India, for example, will only permit savings banks account holders to deposit cash 3 times a month free of cost. Beyond that, it will charge 50 rupees for every transaction. Failure to maintain a minimum balance, 5,000 rupees in metros, will attract penalties. All banks have imposed varying charges for ATM usage as well. So the larger question is, to what extent does this move address the problem of cash? And moreover, will such a move help banks become more profitable in their operations? And finally, is this consumer friendly or is it unfriendly? Well, to discuss this, I'm joined by Ashwin Parekh of Ashwin Parekh Advisory Services, who advises many banks in India, and also consumer rights activist Jahangir Ghai. Thank you both for joining me. Ashwin, I'm going to come to you in a second, but Jahangir, your first reaction, is this something that's friendly or not?
Absolutely unfriendly, absolutely anti-consumer. In fact, my income is taxed, and then when I have to do banking transactions, I'm penalized. Why? Because banks are making losses giving loans to industrialists who fail to repay them.
Okay, but you feel the two are connected? I mean, the fact that they're losing money because of...
Yes, that is why they want to make up from the poor consumer.
Okay. So, do you feel that banks should be allowed to charge some kind of fee for the service?
See, the interest which they give on savings account, let us say, is a miserably paltry 3.5%.
Okay.
Using my money, banks advance loans and earn income.
Okay.
Then why should I be penalized for transacting with my own money?
Okay. Ashwin, let's get your views here. So, what's your sense? Why is this happening now? I mean, it's been happening in some ways. Already some banks have been charging for small bits and pieces, but this time it seems to be a more institutionalized move.
Well, yes. I mean, there are 3 or 4, let's say, different kinds of charges which will have an impact on different classes of, let's say, consumers or customers. One is, of course, the balance. And balance in some form or the other, the justification that we are picking up, and I subscribe to that justification. I mean, the justification is that, let's say, if the banking system had to spend a substantial amount of money on running Jan Dhan program, for example. I mean, the whole idea, and this is applicable, the balance is applicable only in case of metros, but I'm very confident that the banking system will have to evolve some kind of a balance, let's say, mechanism. That is, the customer must keep a certain order of balance in his account for even, let's say, the smaller markets as we go along. And the justification is that the entire thing was rolled out, you know, as some kind of a service to begin with, to include people in the banking system. So therefore, they must be encouraged to use the banking system. The transactions on cash are in some form or the other an extension of, let's say, the policy decision that the government made when demonetization was announced to make sure that, let's say, the economy moves on less cash, you know, therefore on digital sort of, you know, banking kind of or digital currency kind of an environment as compared with the cash economy which we were. Now, it's a disruption. We all agree that it is a disruption. We all agree that the kind of cash which really is required in some of the smaller markets, because we've got so used to using cash for settling our transactions, that this particular, let's say, disruption is going to cause a certain order of dissatisfaction and pain also. But it had to be done, I thought. You know, somewhere or the other, if we are going to encourage digital banking on one side and encourage environments like Bharat QR, UPI, Bheem and such other environments, then I suppose this disruption is really called for. I do know that here, not just the households or individual customers.
Hold your thought there for a moment. Jack, let me bring you back in. So there are different objectives, or at least different stated objectives for this move. So one objective is clearly to say, let's discourage people from using cash. It's not that they don't want you to spend or they want to take away your money, but discourage you from using cash and go digital. I mean, yeah.
In fact, if you see the State Bank's website, even for internet transactions, online transactions, they have a certain restriction. If I not believe, up to, I think, 20 transactions are allowed free.
Yeah.
After that, you are charged. So when you want to encourage banking, why should you have these charges which discourage banking?
Okay. So what in your mind is the way forward? I mean, should banks be not charging at all? Should banks be charging something? Because their point is that when you maintain, let's say, a low balance, right? So the cost of maintaining an account is high. you know, at 5,000 rupees for the bank to earn interest and yet maintain all your databases, keep servicing you, may not be viable.
I'll react to that. We have to consider the sort of economy we are living in. Everybody is not affluent. If you want to reach banking to the masses really, then what you require is that it should encourage even small savings accounts.
Right.
So
But the government is saying that Jan Dhan, for instance, is something that
I'm
is
not
subsidized.
talking of the no-frills account.
yeah.
But let's say people with a nominal balance, suddenly there's an illness in the family, suddenly he withdraws, it falls below the average quarterly minimum balance that is required.
Yeah.
He'll be penalized with administrative charges.
Right.
So I don't think it is really fair. Today you may have a slightly higher balance, tomorrow you may have a lower balance. I don't think this is the correct thing. Why should the basic principle is, why should I be charged for use of my own money on which the bank is earning income?
Okay. Ashwin, why don't you respond to that? You've been working with a lot of banks. How does that argument, how does that argument stack up?
Yeah, well, actually, you see, this is where the entire question of pricing services and charging fees for services comes in. I suppose after the nationalization of banking system, you know, for the last 4 or 5 decades, we've got so used to, you know, a banking system providing services to us at either no cost or at a very low cost. Now, I must say that if we have to really run the banking system on a purely commercial basis, then I suppose for services that the banking system provides, let's say to any customer, there has to be some charge. I mean, even if you take the digital transfers, you know, the cash transferred from one bank account to the other bank account, we have to accept the fact that there are some intermediaries. I mean, how does the data reach the banking system? There has to be some connectivity. Someone like a telecom company will provide the connectivity. There are charges that the system is paying today. You know, so according to a last survey that I carried out on behalf of the Joint Ministry Group way back in 2014, I can assure you that for every transaction that a bank tries to put together, whether it is a transfer or a cash deposit or a cash, let's say, withdrawal, the amount of cost that the banking system incurs is very high. It has not been charging the customers that amount so far. You can also accept the fact that the efficiency in the banking system is improving substantially. If you look at bank-to-bank transfers, you're doing away with a lot of intermediation, you are introducing concepts like MDR. But the service fees have to be there, is the point that I'm trying to make.
Okay, Ashwin. Yes.
Now, if you talk about commercial interest, how many times does a bank give sticky loans, give loans which turn into sticky loans for non-commercial interest because of the need to favor certain people or certain persons who are in power? So where does the commercial interest disappear at that point of time? So therefore, what the bank wants to do is basically penalize the common man to enrich defaulters.
Okay, no, but I think the argument Ashwin is making is that if you were to move towards greater commercialization of a system, then people should pay. It's not because someone has got away by not paying that you should penalize someone else.
Is the bank not earning from my money? If the bank is earning from my money, let it pay a higher rate of interest.
Okay.
Why does it want to restrict payment to me and charge me at the same time?
Okay.
Let it pay a commercial rate of interest to me.
Right. So Ashwin, I think we've seen this argument elsewhere as well, and it's been put to State Bank of India too, that, you know, you've got this whole huge bad loan portfolio sitting there, and we are really, at this point of time at least, paying the price for that.
Well, exactly. I mean, I suppose we are paying a price for a lot of things. I think we are paying a huge price for, let's say, the inefficiency in the banking system, and we are all well aware of it. But I mean, there has to be some change someday. You have to come out of that. You have to make the entire system more efficient. And then we must admit that I mean, with the shortage of capital that is confronting the banking system today, you know, the banking system is gearing itself up to become more efficient. I mean, but then the first thing that they ought to do, and that's something they are now trying to do, is that they at least should recover for all the services that they are, you know, they are providing to the customers, the consumers, be it borrowers, be it small businesses, be it households or individuals.
What is the global example here? So for instance, Jahangir's argument is that the money that I give you and deposit in your account should be, and the interest that you earn on it should be sufficient to cover the services that you give me. How does it work in other parts of the world?
See, let me tell you, in most of the components, particularly in larger economies or developed economies, for instance, the amount of market intervention is very minimum, which means, the level of pricing is totally determined by the market, by the competition, and there is a charge for services. I can straight away say that there is a huge charge for various services. But the only counterpoint to that is that the system itself becomes so efficient, because every small, let's say penny or every small pound will count. And therefore, to that extent, the efficiency is not brought about by either customer behavior of not charging or demanding for fee-less services, or on the other hand, regulators stepping in and controlling the price mechanism, or the policymakers come out and controlling the pricing, like for example they do in case of, let's say, priority sector lending. So those kind of environments you find particularly in our kind of economies, where let's say the banking system has to do a lot of social work as well. And therefore there's a huge dimension of social banking, which brings in a certain order of inefficiency and cross subsidization into the banking system.
Got it. Okay, so Jahangir, are we in the catch-22 situation then? We are in inefficient banking system because of historical reasons, some legacy?
I don't really think so. See, the main thing that we have to consider is what is the sort of literacy rate in our country. How many of our people are educated enough to transact, particularly for online transactions? Then what is our per capita income? All those factors have to be considered. We cannot just take the West. Things are different here. So we have to take those factors into consideration.
No, but your fundamental point is that banks earn enough to absorb these charges.
Absolutely, provided there is no frittering away and frivolous expenses and sticky loans. It is basically the lack of proper management, professional management, which is causing these
And also
problems.
you feel conceptually we should not price these services. That's your position.
Or otherwise, if you are charging me a market rate, you provide me a market rate of interest. If you are charging 36% interest, when I default on a single credit card payment, which merely because I don't get the bill.
But banks are different, credit cards are different, yeah.
Similarly, it's routed mostly through the bank.
Yeah.
Why don't you pay me a similar rate of interest?
Okay, so you're saying it's stacked against you, so therefore you need...
Exactly. So if you are talking of commercial interest, then do it commercially. Everything should be commercial then.
Okay, right. We've run out of time. Thank you, Jahangir. Thank you, Ashwin, for joining in as well. We need to go in for a break. Coming up on the other side, our Indian savers and investors shifting focus to financial assets. And what are the implications? I speak to Navneet Munot of SBI Mutual Fund and Shogata Bhattacharya of Axis Bank. Stay with us.
Homai Vyarawala, better known by her pseudonym Dalda 13, was India's first woman photojournalist. Vyarawala entered the field of photojournalism in the late 1930s. For nearly 30 years till she retired in the early 1970s, at the peak of her career, she made a massive impact. Vyarawala clicked some iconic pictures of political and national leaders. Gandhiji, Nehru, Jinnah, Indira Gandhi have been subjects of her vast photographic collection. Prime Minister Nehru, she says, was her favorite. In 2011, Homai Vyarawala was conferred the Padma Vibhushan, the country's second highest civilian award.
Welcome back. India's mutual fund industry's asset base has hit an all-time high of 17.89 lakh crores at the end of February, thanks to very heavy flows into equity and debt segments. Now, investors large and small continue to pump in savings and other cash month after month into mutual funds as they seemingly look for new avenues to invest. The larger question is, are we seeing a shift in trends into financial assets, either back from other assets for the first time, or second, if investors are indeed moving into financial assets, what does this say about other assets like gold, real estate, or even bank deposits? And finally, what should savers and investors do in coming months to ensure that they invest safely? To discuss this, I'm joined by Navneet Munot, Chief Investment Officer of State Bank of India Mutual Fund, and Shaugata Bhattacharya, Chief Economist at Axis Bank. So, Shaugata, let me begin with you quickly. Are you seeing this trend, and is it a trend?
I'm not sure it's a trend. We obviously have seen, I mean, there's a huge amount of cash that had come in into the
Because in your case,
system.
you're a bank as well as a mutual
That's
fund.
right.
Yeah.
So, I mean, so mutual funds is a symptom. So, I mean, firstly, I mean, equity markets throughout the world have rallied. The Trump trade has kicked in very powerfully. So, I mean, people obviously expect returns. Secondly, with the amount of money that has come into banks without too many avenues to invest, credit growth still remaining muted. Some part of it is getting parked with the Reserve Bank of India. But people, banks, the investors, depositors in banks are beginning to look for other avenues in which to utilize the funds themselves. I think one of the key things that this might be the beginning of a trend, that one are the spread across to the really tier 3, tier 4 cities through via the Jandan accounts. So some money has come in there. And secondly, a bunch of government subventions.
So that is money from outside the banking system into the banking system.
That's right.
Okay.
So whatever, I mean, it used to be cash, it used to be physical savings, which is now coming back somehow or the other. I mean, it's going back again, physical savings. And there's been at the beginnings of a trend, I mean, that there's been some shift out from cash-based channels into more formal electronic digital financial channels. So this might be the
Right.
might be
Okay. Navneet, so how are you seeing it from your vantage point as running a large mutual fund?
So of course, as Saugata mentioned, and you mentioned that there is a larger trend of money moving in towards financial savings, and within that, mutual funds are emerging as a preferred vehicle for the household savings. So whether for liquidity management, for income generation, for of course for long-term wealth creation, investors are moving towards products like mutual funds. We have seen tremendous growth in the industry in last couple of years. In fact, 10 years back, the total assets under management was little over 3 lakh crore, and we are touching 18 lakh crore, so 6 times in last 10 years. Particularly in last 2 or 3 years, we have seen a heartening feature where large number of individual investors are putting money into the equity markets. They are taking a long-term view on the market, and particularly through the systematic investment plan, which is the right way of investing, and investors are signing for long-term SIPs.
But the number of investors in the same period that you said, 3 lakh crore to 18 lakh crore has not grown proportionately, is it not?
So as I mentioned that the number of investors who are putting through the systematic investment plan, they have been growing pretty much in last 2-3 years. Now almost 1.2 crore investors are doing that. But as you rightly said, a lot of investors who came in early in the last bull market in 2006-7, several of them have moved out. But we are seeing a very good trend in last 2 or 3 years that particularly the months where market is declining for let's say global reason like Brexit or a victory of Donald Trump or an announcement of demonetization, we are seeing more investors coming in. So we are seeing a more maturity of investor, the awareness is increasing, mutual funds are expanding even in smaller towns, smaller villages, and I think as more and more banks starts working with us, as more and more advisors starts working with us, awareness is increasing, and I think we will see those numbers also increasing substantially in next few years.
So Navneet, from your travels and your interactions with investors, what's your sense? So how are they reallocating their bucket or basket of funds? Is it because they're moving it by selling something else, or is it additional income and savings that is coming into mutual funds or through SIPs?
I think it's a combination of both. So one, I mean, as you are aware, till 2 or 3 years back, bulk of the savings were going into physical assets like gold and real estate. Incremental money is not going into physical assets, more money is coming into financial assets. So one, a bit of the reallocation within the portfolio, and also as the, I mean, as a country, the amount of savings that we generate every year, incremental savings are moving towards the financial assets.
Right. Okay. So Shaugata, what's your sense going forward now? Do you feel that we could reflect, let's say, trends in some of the more developed countries in terms of how financial assets get laid out, or do you think this is where it'll roughly slow down and stop?
No, I think as Navneet mentioned, I think a large part of this movement is presumably, because we still don't have hard data on this, some movement from physical assets, gold being one, and particularly after the cash, some real estate assets which would have been built, I'm sure has also come back into banks or post office deposits or something. I'm not very sure how long and how more deeply this can sustain, because savings are already, I mean, institutional savings, overall savings are already about 30%, 32%. So I'm not very sure how much beyond this we can move. But I mean, remember, for the household segment, about 10% odd of GDP is still physical savings. So how much of that gets shifted over to financial
So
savings?
if I were to take a step back, so what are the reasons why people could shift to financial assets? So it could be fatigue because you've invested in something and over time it's not given the return that you wanted.
That's right.
Second is that you are looking for a much higher return than what those assets are giving, and therefore you put it into financial assets.
That's basically the sense, because people, however financially literate or illiterate, implicitly have something like a returns at the back of their minds when they allocate their money into assets. The allocation might have been poor, but I think one of the reasons now that more money rather than being invested in homes or something, because that market seems to have plateaued out. The capital appreciation that we had seen, both in actual formal housing as well as in all the rural housing, the informal part which is part of the physical assets, I think that perception is beginning to seep in that maybe we'll not get those kinds of returns. So maybe some part of that is moving into financial assets.
Right. So Navneet, how are you seeing this? I mean, are you attracting from elsewhere? Would you continue to attract from elsewhere, do you think? And then of course my secondary question would be, can this industry sustain those expectations?
I think so, and I think it is apart from some of the reasons that you and Swagata mentioned. I think the ease of transaction, I think the ease of investing, the ease of, I mean, the disclosure standards, your ability to exit, I think the liquidity that the industry provides, the convenience and all that. And just to give an international example, in 1980, the total mutual fund industry size in United States was around $150 billion. And this was a mature developed economy, this was a mature capital market, this was a mature mutual fund industry in existence for 80 years. But between 1980 and 2000, from $150 billion, it moved to $7.5 trillion. 50 times in those 20 years because of 401k happened. And I think India is going through that 401k movement where large number of investors are becoming aware about the need for investing for long term, for their retirement planning, for their children education, for building their next dream home, so on and so forth. They are understanding the awareness that the industry is creating across the country. You can't travel anywhere for 5 kilometers without seeing an advertisement or somebody talking about the mutual fund in any part of the country. So I think all the hard work that has gone, I think we have a long way to go. Still the penetration is very small, and I think that there are still crores of more investors. I think they are likely to join in next several years.
Let me ask the next logical question, Navneet. So can the industry absorb this? You know, because I mean, this is also, I guess, a market performance question, because markets are also quite highly valued. If we see more supply coming in and continuing to come in, can the markets deliver? And therefore, you know, and you know, investors tend to expect reasonably quick returns.
So with the markets moving up, of course, valuations have gone up. Maybe there would be a little bit of correction here and there. Even in a long-term bull market, you see some corrections. Having said that, from a long-term perspective, I think India offers a good opportunity for equity investors. Apart from that, as you asked, are there opportunities to invest? I think still the largest mutual fund in India is a very small fraction of the total market capitalization. The foreign institutional investors still are a much larger player than the domestic mutual funds. So from that perspective, we have a long way to go. Another thing, I think the demand creates its own supply. So we have seen a large IPO getting oversubscribed some 100 or 200 times. We have seen some of the QIPs getting oversubscribed. I'm sure the government will take advantage. A lot of the offer for sale, a lot of new PSUs that may come for listing. Banks may raise a lot of capital. A lot of private equity firms may do the exit through the secondary market. I think a primary as well as secondary market. And I think over a period of time, so much of money that the entrepreneurs need to raise as a risk capital from the equity market, good part is that domestic savings would be able to supply that capital.
So, Shagata, how do you see, you know, the outlook for the next 1 year? Let's say, so you've got bank deposits which are seeing their own inflows because of various other reasons, including, you know, cash, what was traditionally cash. You've got competition from newer assets like mutual funds, and you've got the traditional ones where people are still continuing to invest.
No, remember, I mean, mutual funds at the end of the day still have to deposit in banks.
Okay.
So a lot of the bank deposits that used to be,
and mutual funds are also debt and equity. We sometimes assume that it's all
whatever the instrument, at the end of the day, banks are the only place where you can deposit funds.
Right.
So, I mean, the more money moving to mutual funds and then mutual funds depositing it at the end of the day at the banks, that means a shift out of these CASA deposits into term deposits. And a lot of it is bulk term deposits. As Navneet was also mentioning, a large part of the inflows in the mutual funds have been institutional. So, as you mentioned, that the retail investors have come in the mutual funds,
Yeah.
but the largest bulk have been
Has
from
been-
institutional investors.
Yeah.
So, I think, I mean, obviously, deposits will remain in the banking system, but the structure of deposits are likely to change. And the deployment of these deposits, that's the key question to be asking. Where do you deploy?
Right. So the one concern that you might have in this regard in coming days.
Ability, I mean, you know, I mean, as investors seek more and more returns, obviously, I mean, and the risk management structures are far more robust now. Regulators are keeping a close eye on movements. Again, the fear is that markets become very rich. And at that point in time, a
Right.
bubble-like situation, exactly the same question that you were asking, that, I mean, you know, what is the ability to absorb the amount of capital? Because remember, as of now, there is not a huge amount of demand for funds. Till growth actually moves in and these funds and the funds, the deposits seeking returns comes in, I'm just a little bit worried whether bubbles, I mean, even if it's very concentrated in a few segments or something, bubbles begin to form in the system.
Right. So Navneet, last word and very quickly. So do you see there being competition for funds between, let's say, mutual funds and other assets? Do you see a secular growth for mutual fund industry regardless in coming months?
I think a secular growth for next several years, where one, that the household savings itself increases from where they are today, and within that a larger pie going into the financial assets. Disintermediation is a secular trend not only in India. We have seen that playing in several other parts of the world where similar kind of structural factors were in place, and I think there is a secular growth for the mutual fund industry for next several years.
Right. Navneet, thank you so much for joining us. Shogata, thank you. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.